Hello.
Hey, Mike. How are you?
Good. I sorry, I am a little late here.
All good.
And I flip to that one. There we go. So I was just actually looking at the CME's website where you can get the information about the new futures contract.
Yep.
Um, yeah, yesterday was the biggest day for that contract to date.
Yeah, slowly but surely. I think, for me, it's going to be when the commodity funds ultimately embrace and start to roll their existing positions into the new contract. It's going to be that watershed, push in everybody moment because that's where the liquidity is going to go to. So slowly but surely, it'll happen because it has to happen, pure and simple.
Yep. All right, let's get this thing going.
Let's see
Here we
here.
go.
All right. So, to kind of start like we typically do, start wide and then narrow down into lumber. Um, the big thing that jumps out is obviously you had FOMC last Wednesday up 0.75. That takes your Fed funds rate to 3.25. Target is somewhere in the 4.5 area. So the Fed basically, not basically, he said verbatim that
Oh
inflation.
shit! I'm sorry. You got to pull that back up. I was trying to get cute and pull the name off the bottom there. That didn't work.
There you go.
Oops.
All good.
I think this will do it though. Okay.
So you can see the 10-year, the purple line here is plunged just under 4%, or bond prices of treasury prices are plunging. Rates inversely are moving higher, where the 2-year notes above 4% now. 10-year note is just hovering below 4%. So risk off, basically a summation of what the Fed is saying is that, look, inflation is still our number one concern, and we're going to do what it takes to deal with inflation. So, just like you don't fight the Fed when they're pumping liquidity into the markets here, all assets get inflated. Well, the inverse is true now. They're taking money out, they're raising rates, strong dollar policy. So, again, the big takeaway here, all assets are under pressure. And then when and again, here's that 10-year 3.9. This is actually about a half hour ago, 3.9%. In the grand scheme of things, yeah, it's a big move off the lows here. But prior to kind of the last big recession in 2007, 2008, 2009, you can see that we have been at higher levels, just the reversion back to some type of mean level. I don't know how well this kind of shows up, but these are global 10-year bond yields, and you can see the U.S., U.K. are at a race to the upside here. U.K. over 4%, U.S. just under 4%, and you can see everybody else, really with the exception of Japan. But at least with Japan, you're no longer negative here. You've actually moved positive. But the trend continues of higher interest rates, not just in the U.S. but globally speaking.
Yep.
Um,
And they have to keep up to the U.S. dollar.
yeah,
Or keep
yeah,
up to the
no,
U.S.
absolutely, absolutely. And we'll show a dollar chart here. Dollar continues to surge higher. But going back to rates here, again, these aren't my projections. These aren't economist projections. These are the Fed's publicly released. These are the FOMC's projections on interest rates, on inflation, on GDP, on unemployment. These are all their metrics that they're kind of forecasting. So, okay, so your projection now for Fed funds rate 2022, you're currently at 3.25%. Your projection into the end of this year is a 4.4. Projection for next year is 4.6. Now, look, there's going to be this delineation point where who knows what everything looks like to suggest what the back half of 2023 looks like. but they're telling you that by the end of this year, you've got 2 more rate hikes to go. You're going to be at 4.5% or 4.4%. So you're going to see, we're currently 3.25. You can do the math. There's 2 more rate hikes coming, however they want to do it. That we know that there are 2 more rate hikes coming this year, and then we'll see if they pause, reflect on kind of what this means for the economy as far as all the different growth metrics. And here it is, kind of visually shown a different way. You're at 3.2. This is Fed funds, 3.25%. Here's your forecast into the end of the year. Here's 2023. So into the first half of 2023, you're going to that 4.4, 4.6% Fed funds rate.
Yep. Okay.
So, in the grand scheme of things, what does this mean? Well, again, you've come out of the free money scenario. You're back at some lofty type numbers now, and these are the different Fed chairs to kind of get a perspective. The last time we had significant inflation was Paul Volcker. So, again, I know we've had a dramatic move off of absolutely extreme low levels, but in the grand scheme of things, you just have a reversion back to the mean of some kind of higher Fed funds rate, some kind of higher treasury curve, treasury yield that's reversion back to historical type levels right now. And so here's the, and again, I'm not saying that this is where the 30-year is going, but if you look at the average 30-year mortgage rates in modern times, your average 30-year mortgage rate is 7.76%. So, to put that in perspective, we've come out of some dramatically low numbers, but if you're just going to get some reversion back to some historical mean, that's where you could go. You could go back above 7%. You could go back to 7.5, 7.75%, and you would just be back at average historical levels on the 30-year.
All right, we got our first question of the day. Ding, 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 ding. Tim Hansen, do you get any feeling the Fed rate hikes are in fact having good impacts, and that all these statements of more large rate hikes coming are overstated?
I think until they actually see the metrics to suggest that inflation is until they actually see, if they're purely fixated on inflation, and that's what he said it at his Jackson Hole speech. I'm talking about Jay Powell. He said it last week during the FOMC meeting. They're purely fixated on inflation. And when you look at last week's readings on CPI, PPI, when you strip out energy, when you look at food inflation, you look at some of the other core inflation measures, I don't see the idea that inflation's moderating. And I think that's what they want to see, consecutive monthly. And the reason I'm saying that, I'm going to jump forward here. We'll come back to this, but so here's the Fed's own projections for core inflation. Okay. This is what they forecast for. We're nowhere near the, like you're up over 8 to 10%, depending on how you want to look at inflation. The Fed's own inflation objective projection is 4.5% for the remainder of this year, 3.1% for 2023. So you want to see the actual numbers on a consecutive monthly basis to suggest that inflation is not only stopped moving higher, going sideways, but is starting to move off dramatically lower to get to the Fed's own inflationary objectives or projections. So to me, I think they're telling you, they're trying not to freak out the market. They're telling you exactly what they're going to do. The market doesn't like it because ultimately, again, this is my opinion. What does Powell want? He wants asset price destruction. You want to, how do you rein in inflation? You have lower prices. How do you get lower prices? You have a strong dollar, you have higher interest rates, and that gives you the pause from a demand standpoint, and that reins in prices. This is the Fed's mindset. And look, if they can say, in Q1 or late Q1, Q2 of 2023, inflation's under control, we can begin to moderate. But the idea that you're going to see interest rates dramatically move higher, them pause for a month, and then start to ratchet down interest rates again, I think it is pretty ridiculous right now. I think the earliest you would see any type of decrease in interest rates would be well into 2023, well into Q3 or Q4, where they have consistent months that show inflation's under control, the economy can weather a minor recession, blah, blah, blah. They want to see all these metrics. They actually want to see the numbers because they were so woefully wrong in anticipating the transitory inflation that they have to stay their course or to regain control. Again, that's just my opinion.
It if they don't do anything, you're right. There's too much money in the system floating around. Um, Expectations of lifestyles have to change. Like we have to,
Yeah.
we got to rein it in. We got to get our fiscal house in order.
Yeah. And so, no, and the Fed, no, and they know that they're not 100% accurate, and that's why the further you go out with these projections, they become more questionable. And even they'll tell you that, look, we're more interested in the next 3 to 6 months as far as kind of reining in to get closer to our forecasted numbers, and then we'll kind of evolve thereafter to see how the economy responds. But this is the next chart. The other big takeaway here is twofold. The dollar continues to surge higher. The dollar's gotten up to a 114 last week. A week ago, you were in that 110 type area. So you've had a continued surge in the dollar. And the big kind of negative move here, obviously outside of lumber, copper, has been gold, where gold has acted more like a currency than any type of inflationary hedge so far. And so then when we look at the dollar, you can see this massive surge to the upside here. Again, a week ago, you were at about $1.11. Now the next upside target here would be 19, kind of the onset of the recession back in the early 2000s, where can the dollar get up to this 118 to 120 area? Technically, that's the next stopping point for the U.S. dollar. And so part of this is, again, Fed policy as far as a strong dollar weakens U.S. or U.S. dollar denominated commodities. But then the other byproduct of this, and Mike, I know you referenced this, earlier in our call, is just look at net capital inflows into the U.S. dollar. I mean, you're surging here where you've got a massive infusion of global money. Here's private net foreign purchases. I know we showed these last week, and these numbers continue. If you're going to go into a global recession, the flight to quality is into U.S. dollar. Anything U.S. dollar that's not equity related, you're going to go into U.S. Treasuries, pure and simple.
And the way you do it is you bring assets to the states. So, for us, the easy example, the Europeans bring their lumber to the United States and take a euro denominated asset at its core, turn it into a dollar. And then what are they going to do with those dollars? Well, maybe they roll them into treasuries.
Yeah. And again, when you're, what do you do with your money? I mean, if I can get a 2-year yield, a 2-year treasury at 4% plus, when the Fed's telling me their objective on inflation is sub 4%, what am I missing here? It's just an extension of yielding something, where you're just seeing this inflow of money going into the short arm of the treasury curve. And that's why you're seeing a surge in 2-year, 1-year, 2-year, 5-year, even 10-year, where instead of all along yielding basically zero, to get paid 4% now on a two-year yield in times of uncertainty. Look, the Fed's telling you that inflation's not going to stay at 8 to 10%. They're going to rein it in sub 4% as quickly as they can. So that's why you're seeing this big capital inflow of foreign denominated assets into U.S. dollars, into U.S. treasuries. And so the amazing thing is, we always look at commodity winners and losers, Mike. This is the 5-day. These are your, literally, these are the only commodities up over the last 5 days. I didn't take the top 5. I mean, outside of these commodities, every other commodity that's on bar charts, U.S. commodities list was down over the last 5 days. These are the only ones. So S&P VIX, you had a big sell-off in equities. VIX exploded, Bitcoin for whatever reason, canola, obviously the US dollar is the obvious one. Everything else is a net loser over the last week. And, outside of today, with lumber being up today, lumber, unfortunately, was the leader to the downside, down 14% as of yesterday's close. And so everything else has been taken to the woodshed here. Equities, look at the British pound, copper, um, the Goldman Sachs commodity index, crude oil, all these things have just gotten crushed in the last week as you have this risk-off scenario after the FOMC meeting last Wednesday.
And this is the beginning of it, actually. When you see asset prices, which commodities essentially are assets, coming off, that's the intended target for the Fed rate hikes.
Yeah, and the equity markets now are trying to hold into this 36 50-ish type area on the S&P. We had kind of rallied yesterday and failed. We rallied this morning and we're down again today. So, as much as I want to say you can somehow hang in here, and you're actually below the June lows now in the S&P. So it'll be interesting to see. That's your kind of line in the sand, your next inflection point on the charts. Failure there portends a flush, probably down into this 3,600 area on the S&P for starters.
Yeah, today was a pretty big day in the S&P market. I mean, we were up 60 handles, and then now we're down 20.
Yeah. Dow was up 200, 250 now. Dow's down over 200 again. So that we talked about inflation. Here's GDP, and the only thing I'll say with GDP is your kind of reversion back to pre-COVID type levels. You were at 2.2, 1.9, 1.8, and then you got into obviously COVID. So now you just have kind of this normalization back into those pre-COVID type levels with U.S. growth projections,
which I think makes a lot of sense given we proved that our supply chain could not handle the disruption, the increase in demand, plus the dislocation of human capital. And we proved it. So we need to dial it back and improve that supply chain.
Yeah, and then the last one, and then we'll jump into housing and lumber. But the unemployment rate, you can see, we've obviously had historically low unemployment levels. They do see a moderation, kind of, you're at the low end where the projections start to skirt back up here. And I think for me, it'll be interesting because I was in my local grocery store, go to the stores, labor still, the hourly label, service type labor still seems to be a complete hot mess right now. So it'll be interesting to see if this labor, the increase in the unemployment rate is more white collar driven or blue collar driven. If I'm a betting man, I would have to think it'll be more white collar driven, where people start to rein in their expectations versus the service type jobs, because I still don't think that there's an abundance of the hourly service type people available right now, or at least from my small neck of the woods here, and just going to any store and still having major labor issues out there.
Yep, I agree.
So housing starts, and I think this is a good that just shows total starts, single family versus multi, and you can see how, again, as single family falls out of bed, the beneficiary is the multifamily component. And so, how does this relate to lumber? Well, obviously lumber consumption, but I think the one thing I'll stress with the single versus the multifamily dynamic, first and foremost, there's less wood consumed with multi versus single. And then the other thing, in talking to the big jobbers out there across the nation, the other big obvious thing that's pointed out with multi versus single, from a species standpoint, the multi uses a lot more Doug fir and southern yellow pine, whereas SPF is more of a single family component. So that's something to watch if we're going to shift to multi. Do you see this shift away from SPF? There's less demand for SPF versus some of the other species that are more prevalent in multifamily.
I think, that's a great point.
And I'd
And
like to hear, Matt's take, the different shows coming up this week. If those guys are listening, I'd love to hear your thoughts and take on that. If we're going to evolve away from single family, and here's building permits and the same kind of thing. You're seeing, again, it's more multifamily driven, less single family driven.
yep.
And then again, I highly recommend people follow John Burns Real Estate Consulting on LinkedIn. They put out phenomenal graphical, visual data points. And so these are your 13 markets that appreciated 40% or greater. This is in 2003 to 2005. And then in December of 2019 to 2022, you can see, the top 14 markets that appreciated in the last 3 years here. And the obvious ones: Florida, Texas, Arizona, Florida, Charlotte, the Carolinas. The obvious areas where you've seen big growth, to where now I'm hearing, and I've heard this from multiple sources now, that you're starting to see some of the big nationals cancel their contractual obligations with sawmills into some of these hot areas now, where they're just not seeing the takeaway. So that might explain why certain mills never really raised their pricing and stayed on the market and continue to show more prompt wood, where you're starting to see some contractual obligations in physical cash for October, November, December get canceled at the mill level. And again, I'm all ears. If people have any stories on that, please share your thoughts. I think that's something that's highly important to know as far as demand moving forward, what kind of churns we see from a demand standpoint.
What I think is really interesting. It's never the known fact that really alter the market. It's the unknowns. It's the surprises. And we sit here today, and what we talk about on this show are the knowns, right?
Yep.
And the one known right now is the Fed's predisposition to what they want to do with interest rates. And interest rates, hands down, are the number one driver in our housing market. So I look forward, and I think maybe the unknowns won't have as much impact as they have had in the past.
Yeah, and that could be, the reversion to the mean with lumber prices that's underway. I know the Wall Street published something that, lumber prices this morning.
Oh yeah, I was going to show
that. We're down 70% from pre-COVID type levels, and the reality is that the demand component that's been there organically growing is off the table. So back to reality here.
Yeah, there was a really good quote in that chart, in that article. So as long as we're moving to talking about lumber, oh man, I had it pulled up here. There it is, the Wall Street Journal. Let me move it up here, and I will share this.
Want me to unshare mine?
Nope, I can put this up. So, this is lumber. Lumber's back in the news, but it's not as sexy as it used to be. And, there's some good quotes in here. Our good friend, here's Michael Goodman from Sherwood was quoted. But what I think is the most important quote in the whole article came from Wood Sources. Right here. I'm going to butcher his name. Hakan Ekstrom from Wood Sources. And he says, the consolidation of the North American sawmills by a few big firms, such as Canfor and West Fraser, has hastened the speed at which production is choked back in response to falling prices and should buoy prices. And I can't emphasize that enough. In previous times where there were more decision makers in the market, meaning there were more independent sawmills. Now with this consolidation, you can have one group like Canfor just recently did. They said, we're just going to dial it back a little bit at all of our mills across the board.
Yeah.
And that's a sweeping change.
So it's the old, I've used the analogy in the past that, historically demand was the speedboat that could turn on a dime. Lumber production was the meandering oil tanker in the water, where if it wanted to make a churn, it would take weeks, if not months, to kind of realize that churn. I think with this consolidation, twofold with the consolidation, but above and beyond that, when you give your shareholders with these publicly traded companies technology type returns quarter after quarter, the expectations are that you've evolved into something new, exotic, and different. And the idea that you can go back to economies of scale, just run everything into the ground, and we're going to go back to these single digit, profit margins. I think you've at least conditioned your shareholders now that less is conceivably more. And look, if we produce less lumber in some of the weaker areas and we can give a better return, a better EBIT, a better return to the shareholder, then everybody's on board with that. So I think, I'm not going to quite say that the supply dynamic is the speedboat just yet, but it's much more receptive to change than it was pre-COVID. The traditional lumber model, where it just is so slow to react, I think has changed. And again, for me, to say that prices actually mean something, you're going to see curtailments come out of BC, where you're going to need to see curtailments in places like Alberta, Pacific Northwest, Eastern Canada. That's how you know that lumber prices are kind of hurtful to, you're at those break even type levels when the curtailments come everywhere outside of BC. For me, the BC curtailments have less to do with returns. They have everything to do with long log deck build outs, the availability, scarcity of logs. Uh, um, that's kind of the biggest driver as far as why you see the curtailments come out of BC. When they start to materialize in other places, then I think you're kind of truly at those break-even type levels. You've reached the mill's pain threshold at that point.
Well, and the decision to curtail is an easier decision today for a sawmill if it doesn't have the debt obligation that it may have had in the past.
Yeah, and absolutely, and the free cash flow is monstrous. So I agree there. And so I know you mentioned bottlenecks. So this was John Burns Real Estate again. Building material dealers supply bottlenecks. Are they getting worse, better, or staying the same? And you can see for the first time, there's no red in their latest survey. Where
Oh, that's interesting. Okay.
yeah. So the other thing I want to say, in regards to that Wall Street Journal article, lumber is one piece of the puzzle as far as what goes into a house. So when you look at those other components, the other building materials that go into the house, we showed this last week after the PPI building after PPI, basically the real estate or building materials inflationary numbers. When you look at stuff like gypsum, steel, asphalt, ready mix concrete, electrical componentry, the last inflationary reads were still trending higher. The only one that had moderated off of its highs was steel. So lumber probably is truly your leading indicator, but a lot of these other things that go into building a home are still at their all-time highs or continue to make new highs. So I think for me to get more friendly to single-family housing especially, is you're going to need to see that price destruction in all building materials, not just lumber. You need to rein all those other components back in to truly lower cost to make it more attractive for people to buy.
And it just takes time. It just takes time.
Yeah, and I know Matt. It's funny, Matt Lehman just chimed in on builders backing out of land deals, and that's kind of literally the next slide here. Lennar and KB Homes. They had their earnings last week, and so
Matt scooped you on that.
yeah,
Matt,
yeah. Nice.
one
He,
step
he
ahead.
read my mind. No, that's good. That's good stuff. See, great minds think alike. So, so again, okay. The headline is walking away from 19,000 lots. So again, this is the reason why. Again, John Burns Real Estate. This is, I'll go to this one and I'll come back to the other one. But what does this mean? So here's public builders' earnings, average cancellation rate. So historical average is around 21%. So we're starting to drift back to historical cancellation type averages, but you're still well under. And again, this is a backward looking number, but you're likely to see you're drifting back to that normal cancellation rate right now for public builders.
Got it. All right.
And then I'll go back one slide. This is the reason, as demand for new homes slows, buyers of residential lots and land are responding by, okay, dropping some deals, halting new land acquisitions, pausing existing acquisitions, renegotiating terms, renegotiating on price. So all of the above. And again, when you look at publicly traded builders' earnings, just like the supply side of the equation that's built out their free cash flow, the builders have the lowest debt on record, biggest free cash flow on record. So they have the ability to be a little bit more flexible to sell homes here. They're still highly profitable at these levels. So getting into lumber, seasonality, kind of where we stand this year. September went off last week at 483.50. Of course, we sold off thereafter. So we're just kind of stuck in this downtrending channel formation here. And when you look at from a basis standpoint, a week ago, I'm sorry, this is November continuation historical chart. So today we're in that and this is taking this is taking an average of all futures contracts versus last year versus 2 years ago, since 2018. So you can see these two are your aberration years. You're kind of more normalized now. This is taking the average of the price curve in futures.
We're back to 2018.
Yeah, just like that. And so we had talked about this coil formation where, maybe we could get that breakout to the upside. We failed, and now we're attempting to break out to the downside. And so what does that mean for lumber? Here's a weekly continuation. You're kind of trying to hold into this Bollinger Band low in the 406 area. Now that you're underneath last year's lows of 448, really failure. The next stopping point is right here in this 417 to 420 area. Underneath there, then you're talking about 380 to 350, 351. Those are the next big targets to the downside. And at that point, you're going back to June of 2020. So lumber is officially, with the sell-off yesterday, you're back at June, July of 2020 type levels.
Yeah, I tell you, man, that turnaround from last week really surprised me. I thought we were breaking out to the upside.
Well, the fact that I think the biggest, and obviously hindsight's 2020, the fact that the biggest sawmill couldn't raise their pricing off the mat and kept showing prompt wood just spooked the market. And unfortunately, what all the other mills were trying to do got called out by one mill. So here's that Nov-Jan spread. You can see how we're widening back out. We have gotten out into the 2450 area yesterday. The expectation is somewhere between here into that negative 27, negative 30 area. You're going to have the long Rogers Fund type roll. And people always ask me, well, how come Rogers Fund doesn't show up in the CFTC numbers as far as the long fund? My guess is that the Rogers Fund somehow is categorized as a commercial, and he shows up under the commercial portion of the CFTC type numbers. That's kind of for maybe they own land or something like that, where they're able to categorize themselves as a commercial and not a fund anymore. But the expectation is, just by virtue of the funds, rinse and repeat. As long as the funds are in this market, the second Rogers Fund is out of the way, the spread's likely to tighten again in anticipation of the month-end rolls come the end of October, with the short funds either rolling to January or liquidating their short position in November.
Yep.
And so from skip over I know we're running up against time, but a week ago, November basis was basically on par with physical cash. Fast forward, as of yesterday's close, November, basically, you saw the collapse in futures to where, as of yesterday's close, November was $73 under physical cash. I know we've rallied up a little bit today. We've been as high as 448.50. This is probably your dead cat bounce more so than anything else. Maybe it's hurricane related, but at least from a basis standpoint, as of yesterday's close, you definitely were starting to see value seekers in November and January cover forward jobs. For that matter, November, January, March, in anticipation of forward job covering.
Yep.
And then here's January. Open interest, we continue to build. So the thing that stands out here, Mike, is 21.55 in November, up 73. So you were up 73 in a falling market. So this is probably a good indication that whatever liquidation you've had by managed money shorts, they're probably plowing back into November here this week with this weakness.
I mean, that is still startling to me when you see managed money is the short part of the equation. The industry's not short, understandably so. There has not been a basis opportunity.
Yeah, and so just to, like kind of where does that Rogers fund show up? They're either here in other reportables or they're here somehow. They're no longer here for whatever reason. And everybody, that trades greater than 20 contracts has to fill out a CFTC Form 40. So that's how the CFTC derives these numbers. With large traders that again have positions of 20 or greater contracts have to fill out legally required to fill out a CFTC Form 40, and basically all it does is categorize you into one of these areas. So total open interest. Here's the again, you referenced this. The mini contract had nice volume yesterday, and we're starting to see a build of open interest. And again, as we progress, you're going to see these numbers get bigger and bigger. And so the beauty of I said yesterday that Nov Jan spread, the widest it traded yesterday was negative 24.50. The mini contract yesterday traded out to 29.70. So you're getting a little bit more amplification because of the illiquidity in the mini. So where there's some good opportunities if you're willing to arbitrage and put a stake in the ground. There's some good opportunities in the mini contract. The other thing that I'm hearing, and I'm all ears, is that so rail car stats, you can see Canada is kind of moderating. I'm hearing from multiple sources now that BC and Alberta mills are getting full rail car allocation, or certain mills, certain locations are getting full rail car allocation and also getting extra cars now. So I'm all ears there what people are hearing.
Yeah, I think the overall supply chain is right-siding itself.
Yeah. And it'd be interesting to see if mills, in fact, are getting a greater rail car allocation than they've asked for. And then, again, you're still seeing, again, this is shipments in Canada, origination in Canada, but when you cross the border, how it's still a mess there. Where we still haven't normalized after the leading up to the strike of U.S. Railroads.
All right.
And that's all, Mike.
My takeaway right now is it might just get boring here for a little while. It's kind of the time of the year for it to get boring. You commented that we saw Canfor pull some volume off the market, and it was a flash in the pan. We've got a massive hurricane headed towards the southeastern United States. Everyone's like, huh.
Yeah, and I think to get this market going, it's going to be some kind of extraneous event, whether it's a hurricane, and typically hurricanes are buy the rumor, sell the fact. I mean, when you look historically at hurricanes, unless there's straight line wind damage, most of the damage is flooding related. So it's less dimensional. It's all OSB, CDX panels. That's where you get the bump up in consumption. Like, what's the catalyst to, ultimately, how does this market right the ship and go dramatically higher? Well, pure and simple, it's these guys right here decide to exit stage left. And given the uncertainty and all the other headwinds out there, I'm not sure, outside of just sheer profit taking, we want to be done with this trade. I'm not sure what that outside event is to get these guys to say, all right, we want out of this position. But that's the obvious, how does this market go higher? Well, it's going to be, you get a short covering rally with the managed money component here, but I'm not sure what the rationale outside of just taking profits off the table, just seeing everything out there right now. I'm not sure why they're going to be exiting this strategy anytime soon.
To me, it takes the Fed putting a pause on, the Fed coming in and saying, okay, you know what? Here's the known. Right now, the unknown is the Fed is going to keep going until they see a reason to stop. So if the Fed sees a reason to stop, that pauses interest rate hikes, and it allows the market participants to make a decision. Right now, we're caught in the unknown, and it's, just.
Yeah, and I will say, when they do release the FOMC minutes, they'll, like everybody obviously is a voting Fed governor. They do release, dissension as far as, okay, this group wanted 0.75. So the other group that didn't want 0.75 wanted a full basis point or greater. So what you'll start to see is there will be a group that just wants to pause or do something less, and that'll be your forward-looking indicator as far as, the Fed pausing. So maybe next month, instead of, let's say that they do it 0.75, maybe there's a group that only wants to do it 0.5 or 0.25. You'll start to see that group slowly build, and that will be your kind of your leading indicator that the Fed's getting ready to pause. But you're going to have to see some serious dissension among Fed governors that actually vote that no, we want to put the brakes on this. Right now, again, it was a question of 0.75 versus a full basis. So there are more rate hikes. There's at least 2 more rate hikes to get us to the Fed fund target. There are 2 more rate hikes coming this year.
Yep, and everybody knows it. That's the known.
And that's the idea, is that this shouldn't be a surprise. The markets can react the way that they want to, but again, the uncertainty of the Fed with transitory and all that other stuff, they're trying to be as crystal clear as possible now that you're going to hear consistency in the different Fed governors when they speak publicly at different forums, conferences. We are getting to 4.5. We're getting to our Fed fund target here ASAP.
Yep. Let's wrap this up with an encouraging note. Greg and I offline were talking about this new futures contract and what a great way it is to lock your contracts to. You can choose to a contract with a mill based off of a reported price or off a reality. And the futures price is a reality. That is absolute consensus in the market, with people showing with their actual money what they want to do.
Yeah, absolutely. I would much rather tie my contractual obligations to something that's fluid, something that's liquid, like futures, versus relying on a publication that at times seems to be 180 degrees from reality for the vast majority of the industry. So, that's the other thing. We're actively trying to get participants on both the buy side, sell side from an EFP standpoint. And I think over the next really 3 to 6 months, you're going to see a massive infusion of new buy side and new sell side EFP participants as a result.
And there were 28 EFPs done last.
In September. Yeah,
and they were truckloads.
They were truckloads. Yep.
Straight trucks, which is, hey, there you go. That's fantastic. All right, let's wrap this up. We'll see everyone next week, and I'm sure we'll have lots of fun stuff to talk about then. In the meantime, if you have any questions, reach out to Greg or myself, and be safe out there.
All right. Thanks a lot, everybody.
Bye-bye.
Hey, Mike, stick around for a